we're seeing not just a lot of gold flow to the US in the last few months, like over 2,000 tons, but a lot of silver also is flowing. I think the bullion banks are, yeah, they're trying desperately, and I'm sure they keep track of the the gold and silver bugs and the silver squeeze, and I'm sure they've done their darndest today to keep the paper price down on silver squeeze, but I think it's just delaying the inevitable. Yeah, eventually things like that are not sustainable, they fail, and when people want their physical.
Good evening, investors and economic observers. You're watching The Economy Express, your trusted destination for global market insights, gold and silver analysis, and unfolding financial dynamics. Tonight's top story comes from veteran, analyst, and financial historian Mario Innecco, who issues a powerful warning to silver stackers and gold holders alike. If you've been tracking the precious metals market, this is an urgent update you'll want to hear from start to finish. Let's begin with silver, often the underdog in the precious metals space, but now rapidly moving into the spotlight. Mario Innecco points to a growing and dangerous disconnect between the paper silver market and the physical silver market. He says while retail investors are understandably frustrated that silver continues to trade sideways in the mid-30s, the real story is happening behind the scenes. Thousands of tons of silver, along with substantial gold flows, have been quietly moving into the United States in recent months. The physical market is heating up, but prices remain suppressed.
Looking this weekend, past weekend I think on the live stream with Clive, and silver actually up until Friday, year to date, is outperforming gold by 1% or 2%. So I think the reason people are frustrated is because gold is making all-time highs, like there's no tomorrow, and silver is still stuck here in the mid 30s or so, and the all-time high is 50. But as I said, patience I think is needed, and stop buying ETFs, buy the physical, and there's no excuse. In my opinion, I've never bought a silver ETF, and if you remember, I mean, I've spoken in the past about how all the gold prices in different currencies have been going up, and how the Japanese yen has been leading this race down to zero. But we're also seeing now that in other currencies, silver is actually trading to new all-time highs, like with the Canadian dollar, with the Aussie dollar, they're trading like above 50. So I think it's, yeah, that's what's going to happen. And I think the fundamentals for silver are still really good. 5 years of deficit in the silver market, i.e., there's more demand than silver that's produced or recycled. And we're seeing not just a lot of gold flow to the US in the last few months, like over 2,000 tons, but a lot of silver also is flowing. And who's to say that another billionaire or another 2 or 3 is not going to emulate David Bateman? I think it's very possible. And yeah, I think the bullion banks are, yeah, they're trying desperately, and I'm sure they keep track of the gold and silver bugs and the silver squeeze, and I'm sure they've done their darndest today to keep the paper price down on silver squeeze, but I think it's just delaying the inevitable. Yeah, eventually things like that are not sustainable, they fail, and when people want their physical. Their argument is that they hedge it on the LBMA, and they buy these OTC promissory notes or forwards, which forwards are just another future, and we've seen that in the LBMA. These OTC promissory note contracts are just they're not really physical. if they were physical, the Bank of England wouldn't have a delay of like a month to 2 months in delivering gold. And yeah, so when they come out and say, "Oh, you guys are crazy," these massive shorts are covered because we're long in the LBMA, but they're not really long physical, and that's the problem. But eventually, it will it will come out. People are waking up to it, and I think Eric Young, aka King Kong 9888, he's done a really good job of explaining how they use the EFP mechanism to execute this scam of pretending that paper is physical. And EFP stands for exchange for physical, but it's all settled cash. So basically, the LBMA is like a bucket shop. There are kinds of brokerages in the early 1900s where you could bet on the price. You weren't buying any stocks or selling any stocks, and I think that's what the LBMA is. COMEX, to some extent, is also a bucket shop, but it's not as leveraged as the LBMA because there's no regulation. The LBMA, the banks that trade in London, they're not regulated by the Bank of England. They're like self-regulated, so they leverage many times over. While COMEX in the U.S., the leverage is less. It's about, I don't know, COMEX, you have to put 10% down, so it's not.
Why? According to Innecco, it's the bullion banks, institutions with massive short positions in silver, that are keeping the paper price low through derivatives like futures contracts and ETFs. But he says this is only a short-term fix, and it's delaying the inevitable. Eventually, investors will demand physical delivery. And when they do, the supply won't be there. That's when the real silver squeeze could begin.
News, but I've seen someone post recently, I don't remember who it was, but if you look back when gold made its big runs like 79 to 1980, there's a huge crisis then, a recession. Paul Volcker had to let rates go to 15%, so it was forecasting some trouble ahead. For some reason, gold does that. And back in the 2000s, yes, gold was in a bull market from '02 to like 2011, but it really started picking up like in 2007 all the way to March 2008 when we topped at 1,000, and then we had the subprime crisis, and then we had a big move up in 2011, and that forecast the European sovereign debt crisis. So I think what's going on now, there's so much out there that is, how can I say, pointing, well, there's some indicators that are worrying, like the Japanese government bond market. The yields there are going up very quickly. The Japanese yen is strengthening. U.S. Treasury yields are still really sticky. They're not really going down as much as people expect them to. What else? The stock market seems to have topped. We're down on all the three indices year to date. So yeah, I mean, as for today, it's just a continuation of what we've been seeing. So yeah, I think gold is pointing to trouble ahead, but it could also be pointing to something that I've been warning about for years since I.
These distortions, Innecco says, cannot continue forever. The moment of reckoning is coming. Silver is now entering its 5th consecutive year of structural deficit. That means more silver is being consumed in electronics, solar panels, electric vehicles, and investment than is being produced or recycled, and that imbalance is growing. At the same time, more and more investors are waking up to the fact that paper silver doesn't equal real silver. Innecco warns that when these paper claims begin to unravel, prices could spike violently. His advice is crystal clear. Stop relying on ETFs and futures and start buying physical silver. In his words, there's no excuse. He's never purchased a silver ETF, and he's not starting now. While silver is setting the stage for a potential breakout, gold is already roaring. Gold has surged past the $3,160 mark per ounce, defying expectations and smashing through previous resistance levels. Analysts at Goldman Sachs, Bank of America, and Societe Generale are now adjusting their forecasts upward, with Bank of America placing gold at $3,300 per ounce by year's end. What's driving this rally? According to Innecco, it's not just inflation, it's a collapse in confidence. Around the world, investors are losing faith in the dollar, the euro, the pound, and the institutions that back them. Trade tensions, rising tariffs, political instability, and central bank mistrust are sending capital fleeing from equities and fiat currencies. Gold, as always, is the safe haven of last resort, and it's proving its worth once again. Innecco believes this rally is signaling more than just economic turbulence. It may be pointing to hyperinflation, not the kind driven by rising costs, but by a breakdown in trust. He draws comparisons to previous periods of crisis, the stagflation of the 1970s, the financial crisis of 2008, and the European debt crisis of 2011. Each of those episodes was preceded by a major gold move. And now, he says, it's happening again. Japan is showing signs of bond market instability. The yen is rising sharply. Treasury yields in the US remain stubbornly high. Stock markets are losing steam across all major indices. The signs, Innecco warns, are everywhere, and they point to growing financial risk and the very real possibility of a breakdown in the global currency system. But there's another part of the story that investors need to understand, and that's the illusion of paper assets. Innecco goes into detail on how the London Bullion Market Association operates, comparing it to a bucket shop, the kind of establishment from the early 1900s where traders could bet on prices without ever taking delivery of the underlying asset. He explains how the LBMA uses promissory notes and exchange for physical mechanisms to maintain the appearance of metal backing. But in reality, these are often cash-settled and never involve actual silver or gold. He notes that if these contracts were genuinely backed by physical metals, we wouldn't see month-long delays in gold delivery at the Bank of England. He also credits independent researchers like Eric Young, known online as King Kong 98, for exposing how the system leverages paper mechanisms to manipulate price and keep the illusion of liquidity alive. According to Innecco, the LBMA operates without direct regulation from the Bank of England, and its leverage is far higher than that of COMEX in the United States. When the illusion fades and real delivery is demanded, the fallout could be swift and devastating for those still holding paper. So where does that leave investors? Innecco's advice is simple but urgent. Stop trying to trade gold and silver and start holding them. Not for quick gains, but for protection. Protection from collapsing fiat currencies. Protection from central bank failure. Protection from political and social instability. He warns that confidence in Western leadership is reaching historic lows, particularly in Europe, where political repression and lawfare are eroding public trust. And when that trust disappears, so does the value of the currency those governments issue.